why hasn't the market crashed? In today's video, we're going to be discussing that. And if you own any investments at all, so stocks, 401k, bonds, or even cash, there is a silent killer that's going through the market that no one is talking about. So let's jump into it. The stock market is at all-time highs while unemployment is rising, which is strange because usually those don't go together. This almost never happens except for times like we saw in the past, where millions of people were wiped out because they didn't understand what it meant. In the next few minutes, I'm going to show you exactly what Wall Street already knows and how to position yourself in this market to protect your gains and potentially make some money in the bull run. My name is Jonathan Little. I have been investing in the stock market since I was 17 years old. And after going through a rough divorce, I really wanted to better my life and learn how to invest. So that's exactly what I did. And right now, I help other people just like you learn about the market and how you can make money as well. So let's dive into it. Shocking numbers of what's happening in the market. So let's put this into perspective. In April 2025, the market crashed about 5%. And then another day, it crashed another 5%. So in just 48 hours, $6.6 trillion of wealth just disappeared. If you had $10,000 invested, you would have lost about $1,000, so about 10%. So that's like real money that people are losing. They're seeing in their 401ks money disappear. Now, here is the weird part. So within weeks of all of that happening, by June, the market was higher than before the crash. And now it's at all-time highs, while unemployment is the highest in 4 years. Why this makes no sense is because the Fed has cut rates 3 times in a row. The US government is spending $2 trillion more per year than it brings in. And then there's companies like Nvidia that are worth more than entire countries. And just the top 7 companies of the S&P 500 are responsible for nearly all the market gains. So this is not exactly a healthy market, and that's kind of more of a concentrated risk in those top 7 companies in the S&P. So the average household, let's say, has a portfolio of $1 million, the average household. Or maybe we'll say the average household has a portfolio of a little less. Maybe we'll say $500,000. That is like $500,000 worth, all of that money primarily being in 7 stocks, although it should be kind of spread over 500, 600. And that's kind of what the S&P is. It's a basket of 500 stocks of companies that are the top 500 in the US. So if all of that $500 is primarily in those 7 stocks that take up, I think it's like 60 or 70% of the 500K, when there's movements in the portfolio, when there's movement in the market, that means that your portfolio is getting drastically affected by just a few positions, which essentially doesn't necessarily mitigate risk. But this has happened before. So back in the 1970s, there was something called stagflation. Prices went up, jobs went down, the market fell about 50%. And then in the 2000s, the dot-com bubble happened. Obviously, most people know about that. So when there's a hype around the websites and electronics, which is why it's referred to as the dot-com bubble. This time, it was a little different with the 2008. That was caused by obviously banks with subprime lending that caused some in 2008, obviously there was the crash that was caused by subprime loans. Now, the hidden risk, and even thinking of most recently in 2023, Silicon Bank, when that was quite a surprising event because the Silicon Bank is the top 10 bank in the US, okay? So every time the markets rise and fundamentals weaken, history shows similar patterns. The question isn't necessarily if the market's going to crash, but when and how it's going to affect your portfolio. So why the traditional solutions don't quite work in this day and age? And what can governments do? And why are they just seemingly just printing more and more money? Because that leads to stagflation. Should they cut spending? Politicians lose their jobs. So for example, if you were voting for a politician that's saying, oh, we're going to spend a lot less, you probably wouldn't vote for them because your grandparents are on different programs that are needed. Maybe there's someone in your family who's in need of support systems from the government. They don't want those programs being cut. So the question becomes, do we raise taxes to pay for these things? And it's kind of like putting all of that extra spending on the country's credit card. At some point, you're going to have to pay that back or just print more money, which is what they have been doing. The other solution is growing GDP. Now, if you had to grow GDP to pay off this extra debt and stop the printing of money, there would have to be a roughly 8 to 10% GDP growth for decades and decades. So that's most likely never going to happen because that is super unrealistic. So there's no traditional way out. Wall Street understands something most retail investors don't. The real reasons the markets are up is very, very simple, and I will show it to you here on the iPad. All right, let's hop over here to the iPad. Hopefully you guys can see all that fine. So the real reason that the market is up is for this simple example. This is the flow of money. When the Fed cuts rates, this causes there to be more borrowing power. So then what happens is the banks lend out more money. When the banks lend out more money, it means that they lend easily because they have lower rates to do so and people will borrow more. And so in turn, what does that causes corporations to buy back stock, which is very interesting. And when they buy back stock, what happens is they're selling more of their product. So what that leads to is consumers spending more, which in turn leads to more profits, and then they buy more stock. And that is how the flow of money works. So when there's more money printed, it usually just makes the rich richer because of this system. Whoever owns the companies will continuously get that money and then being able to invest it in their company and purchase extra stock, which essentially, and we'll go to the next one, that leads to all the spending boosting the markets artificially. Remember, this is not a real growth of natural GDP. This is them pumping money into the markets to cause a sense that the markets are growing and the economy is doing good, which we already know that jobs are lowering, less and less jobs creation, there is more unemployment, and rates are being lowered for a reason. So this leads us to the example on inflation. I thought this was really interesting. So let's say there's $100,000 in a savings account at 1%. So you worked hard, you saved up 100 grand, and you have that 1% interest rate in a high yield, which is nothing, but we're just using it for simplicity. After 1 year, the 100K becomes $101,000. You might think, okay, well, that's good. You made some money. But that is false because there's an invisible power that's actually taking away the money, and it's called inflation. And this is how inflation is more of that silent killer. 2.99% is the average inflation. With that being said, do you believe that 2.99% is the actual inflation? It's very hard to tell, and we could talk about this for a long time, even past this video. But what I will say is if we just use these numbers, that means that your $101,000 is now actually worth $98,100. So your $101,000 that you thought you made $1,000, you lost $1,900. So that's a loss. So we'll write that, a loss of $1,900. So you might be asking, how do we actually protect from inflation? Because maybe it's higher, maybe it's 4%, 5%. So if we just leave our money even in the S&P and it averages 10%, there's only a 6% split on that. That's the delta. So even then, you're not averaging a ton. So would you put your money into hard assets or just keep doing stocks? That is the real question. And this might be the real answer why the market hasn't crashed yet. If we go over to if we go over to gold and we look over the past year, we had some substantial growth, very substantial. If we look at the 5 years, there was lots and lots of just more of just stagnation in there. And then boop, once 2025 hit, it absolutely did fantastic over the past year, going all the way up to almost $5,600, which is crazy. So if we use that same example of the $100,000 invested, but this time we put it into gold, would you be better to do it in gold or the stocks? I'll leave it up to you guys. Let's guess. And who wins and who loses in that scenario? So we already looked at the person who just put their money into a high yield savings account, didn't work out too well. Now let's go over to gold. If they put their money would be worth roughly $168,000. Okay. So you'd be doing really, really well in there. And obviously there's factors in there, but it would be approximately that amount. So would you rather have 168 or 101K? 101. I know which one. I would choose the 168. Okay, so now we look at bonds. How do bonds work? So there's corporate bonds, there's short duration bonds, and then you want to avoid more of the mature bond sector. So if you're going to avoid gold, you're going to avoid stocks, and you want to keep it safe, those are some solutions. These ones are obviously a little bit higher yields. Obviously, I'm not a financial advisor, but that is what I've seen. These ones I would kind of stay away from. And then how do you protect yourself? In this market, if there's a 10 to 50% in high yield savings, so cash, that is a really good indication in case there's a job loss, to be able to cover your expenses, your lifestyle, and still be able to invest even if your job hasn't been affected. And this is crucial. The next piece of protection, just like we talked about, real assets, looking at gold and silver, and looking at real estate as well. If you look at real estate over the past 40, 50, even 100 years, fantastic returns, but most of it was just keeping up with inflation. If we use that example of a $100,000 house and it goes up 4 to 5% per year and equaled out over 30 years, maybe the home is worth roughly 1.2 million, but with inflation, that same 100K is now about 1.3 million just to keep up with inflation. So technically you're breaking even on the real estate. Diversity in different sectors and stocks. So just like we discussed with the S&P, that basket, your basket of stocks of 500. With the top 7, the Mag 7s, if you don't know what those are, Google, Apple, Tesla, stuff like that, Nvidia. Or if you were to diversify a little bit, maybe in some, let's just say some computing, or we look at a little bit of AI. And then we go into a little bit of global, okay? If we compare different funds, that's how we're able to consistently keep safe in the portfolio. And don't wait. Guys, there's no reason to wait for a crash. If you're waiting for a crash, we always joke about it. You're waiting for an invisible time. It's better to invest, keep invested, diversified in the markets. And then with the new Fed chair, so let's discuss this. The federal chair, being that there's going to be a new Fed chairman, if there is more of a supportive Fed, I think a great portfolio diversification for myself will be roughly 60 to 80% in stocks. And then you could look at the rest into real assets, such as like gold, silver, real estate. Okay. If they're more hawkish, it might be a good selling opportunity. Maybe diversifying 50 to 60% in stocks and then the rest in these ones as well, into the real assets. And so this is portfolio diversification. And we're going to get into this deeper as the weeks come throughout this. And we're going to keep you updated on exactly what's happening in the stocks right now. But that is really what it's about. And so the real question, when will it collapse? The real answer is, I don't know. No one knows. There's not a sphere, a magical ball to be able to tell you the exact answer. But what we can tell you is there's 3 steps that you can do in your portfolio to make sure that you're keeping your investments safe and you're able to keep them in a good spot where you can sleep easy at night and build your wealth. Number 1, audit your portfolio. Look at the numbers, guys. See exactly what's happening in your portfolio. And is there any, massively overhyped AI stocks that you should probably get rid of? Is there too much into one sector or stock? And then diversifying your portfolio for that risk management, not being scared to make the moves, but always thinking long term. In the next 15 years, will this benefit me to make these moves? We do talk about this a lot more in the mentorship that I am launching, but for right now, I'm just releasing the free YouTube videos so you guys can stay up to date on what's happening in the market and what you should look out for in your portfolios as well. If you did enjoy the video, just leave a like, subscribe, and let me know what is the main position that you're holding right now in your portfolio. With that being said, take care, guys. Peace.